We have heard enough stories of recent banking crises across the West. Banks that are supposed to be guardians of citizens' money are themselves suffering from a liquidity crunch in Western countries. What were the reasons for collapse of US and European banks? How RBI's stringent norms saved us from 2023 banking crisis in India? How India's regulations keep banks' balance sheets safe and healthy? First, let's understand the reasons for fall of the Western banks and what was RBI's move that proved to be a savior. Let's understand the fall of Silicon Valley Bank. Well, there was a clear asset liability mismatch. They had a lot of short-term funds parked in long-term US Treasury bonds. In other words, there was no liquidity. So, when Federal Reserve increased the rates for 7 times continuously since 2021 to tame the inflation, an inverted yield curve scenario proved fatal to SVB. What is inverted yield curve? Well, generally investors should be rewarded with higher rewards for holding an investment for longer term. Hence, the normal yield curve slopes upwards. However, this yield curve inverts when the return on long-term investments falls shorter than that on short-term investments. The yield on long-term bond fell in the secondary market. This depreciated the value of SVB's bond holdings. Hence, when the depositors rushed to withdraw money, they had no option but to sell off their investments in bonds at a huge loss. So, how did RBI save us from impact of inverted yield curve? The RBI unexpectedly kept the repo rate unchanged, breaking the cycle of 6 consecutive hikes since May 2022. The trouble with interest rate is that when they start to move up, they hit the banks the most as the cost of funds go up. Hence, it is a pleasant pause by RBI to hike the interest rates. Almost the same factors contributed to the failure of Signature Bank that had recently made a play to win cryptocurrency deposits. RBI's governor was always of the view that cryptocurrencies should be prohibited as it is nothing but gambling. If the transactions start happening via crypto, then RBI will lose control over the money supply in the economy and its authority to decide on monetary policy and level of liquidity will be undermined. There was turbulence in Europe as well due to Credit Suisse. However, Indian banking system is insulated from this as well, as India has the least foreign claims. Foreign claims is nothing but domestic banks' claims on non-residents of the reporting country. RBI's policy stance has been conservative one and has hinged largely around compliance to stringent regulations for banks to ensure enough liquidity, capital adequacy and accountability. RBI's draft guidelines for the implementation of Basel III norms, that is, the global regulatory standards for capital adequacy, are credit positive as they are more conservative one. RBI conducts frequent stress tests and tight monitoring. The RBI's proactive risk management is likely to protect balance sheets under any adverse scenario. The Indian banking system remains relatively insulated, with public banks more immune to liquidity risk due to their higher liquidity coverage ratio and lower credit deposit ratio. Let's understand what is liquidity coverage ratio. It's nothing but high quality liquid assets divided by total net cash outflow over the next 30 calendar days. And what is high quality liquid assets? It's any asset that can be easily and instantly converted into cash. What is credit deposit ratio? The ratio of how much a bank lends out of the deposits received from depositors. A very low credit deposit ratio indicates banks are not making full use of their resources. It would mean that not all the deposits are utilized in lending money to the borrowers. The CDR of public sector banks across India from financial year 2012 to 2022, you can see in this graph. It is 65% in FY 2022. LCR for the quarter ended March 31st, 2022 stood at 311% and CDR stood at 72% in FY22. The loan to assets ratio for Indian banks is around 36%. Additionally, the investment is more into government securities on SLR account. What is SLR? The minimum percentage of deposits that the commercial bank maintains through gold, cash and other securities. The deposit base for Indian banks is very granular as the top 20 depositors contribute around 9% of total deposits. To understand why RBI prescribed stringent requirements, let's understand the historical events that happened in 2018. 2018 saw significant challenges for Indian economy. Primary reasons being related to economic policies, global factors, and domestic issues. Firstly, in 2016, the Indian government implemented a demonetization policy which involved the removal of high-value currency notes from circulation. This policy had a significant impact on the economy as it led to a temporary slowdown in economic growth and disrupted businesses and households. In 2017, GST was introduced in India, which aimed to simplify the country's complex tax system. However, since GST laws were complicated, the implementation was not smooth and it led to confusion and disruption. Delays in getting input credit troubled the exporters and small businesses. So, although GST law enactment was for long-term benefit, its adoption was painful in the short term. The global prices of crude oil increased significantly in 2018. Which had a major impact on the Indian economy as the country is a net importer of oil. This led to higher fuel prices, inflation, and an increase in the current account deficit. The Indian rupee depreciated against the US dollar in 2018. It led to higher inflation, increased the cost of imports, and made it harder for businesses to repay foreign debt. And lastly, in 2018, there was a major banking crisis. Several major banks, NBFCs, including Yes Bank, Infrastructure Leasing and Financial Services, that is ILNFS, and Punjab and Maharashtra Cooperative Bank collapsed, which led to a loss of confidence in the banking sector. This in turn had a negative impact on the economy as it was harder for businesses to access credit. Yes Bank was primarily a major banker for emerging and mid-sized enterprises. Due to the economic tensions, such mid-sized enterprises started feeling the heat and Yes Bank folded up because of a deteriorating lending book. The banking sector saw a rise in NPAs. How much? 10.35 lakh crores. Credit growth slowed down. These events and factors had a significant impact on the Indian economy in 2018 and led to a slowdown. However, the Indian government and RBI took several steps to address these issues. After the banking crisis in India in 2018, RBI took several steps to stabilize and future-proof the banking system. How? Firstly, moratorium and restructuring. Yes Bank was put under a moratorium, which included superseding its board and replacing its management. With blessings from the government, the RBI came out with a restructuring plan for Yes Bank, where domestic banks, led by country's largest bank SBI, invested 10,000 crore in the bank. RBI set up a committee to review the functioning of asset reconstruction companies. The RBI implemented a prompt corrective action framework, which involved monitoring the financial health of banks and taking corrective measures to prevent them from deteriorating further. Under this framework, banks with weak financials were required to take corrective measures such as reducing NPAs, improving capital ratios, and controlling expenses. On February 2018, RBI issued a circular laying down the process of banks having to recognize bad assets. India's banks wrote off around 2 trillion worth of bad loans in 2018 to 19. The Indian government announced a plan to recapitalize public sector banks, which involved injecting capital into these banks to improve their financial health. RBI also strengthened the regulatory framework. It implemented several measures to strengthen the regulatory framework for banks, such as improving risk management systems, enhancing transparency, increasing the accountability of banks and their management, and reduce the risk of fraud. RBI introduced several new rules and regulations to improve the functioning of the banking system, such as requirement for banks to maintain a minimum capital ratio of 9%, that is, bank's capital in relation to its risk-weighted assets and current liabilities, and 12% for public sector banks. It laid down guidelines for lending to large borrowers, restrictions on lending to companies that have defaulted on their loans. RBI encouraged banks to embrace technology to improve their operations and increase efficiency. This include initiatives such as introduction of digital payment systems, the use of AI and machine learning in risk management, and the development of a unified payment interface for seamless transactions. These steps taken by the RBI have helped to stabilize the banking system in India. The ratio of bad loans to total loans has declined, which is 5% currently, and capital adequacy ratios have improved. The measures to strengthen the regulatory framework have increased transparency and accountability and reduced the risk of fraud. The adoption of technology like AI and ML in risk management has reduced the risks. All of these steps have helped to increase investor confidence in the Indian economy. Even as the global turmoil continues in financial markets and global growth outlook looks dim, the macro factors are turning better for India. In India, the economy is on an upswing and growing rapidly. The capex cycle is upbeat, especially in the private sector. The country's GDP growth rate has improved by 7% last year, and inflation and current account deficit have remained under current control, that is below 2.5%. The long-term benefit of the hike in interest rates remains to be seen, but the steps taken by the RBI to stabilize the banking system have helped to make it more resilient in the face of these challenges.